All right, everybody, we're going to go ahead and get started. Hello and welcome to the Thursday Process with Richardson and Richardson. And we'll go ahead and dive on in. A quick disclaimer here at the top. These presentations are intended for educational purposes only. They should not replace independent professional advice or your own personal judgment. Statements of facts, opinions expressed are those of the participants, us individually. They don't represent the opinion or position of their employees or any sort of certifying bodies. Nothing in this presentation should be considered legal or financial advice, especially not financial advice. So get independent counsel there. Also, you may be watching this on demand. If so, please consider we have not updated the recording or the information since the original presentation. Today is October the 6th of 2022 at 11:30 Eastern. So this is when we're recording it. That's when you're watching this content. It's not being updated. A couple little bits of housekeeping before we dive right on in. There are polls that will happen. They will pop up on your screen. Please answer them. Those polls help us inform and present better content, so they're highly valuable. We appreciate you giving us a little bit of information. If you have questions, there's a Q&A thing up at the top. Go ahead and throw in your questions. We will answer them live. That's one of the key deliverables here, so you don't have to hold them back. We'll have a little bit of time at the end, but ask live. Last but not least, there is a handout section. The process we're talking about there should be shared. If you have any issues, throw out a question in the chat. But that's your handout to keep. We're not going to be showing it on the screen, but we will be using it as reference material throughout the presentation. So that is the process that Zach and their team use for raising capital. That's what we're talking about today. Without further ado, who are you talking to? I'm Ian Richardson. I'm one of the Richardsons at Richardson & Richardson Consulting. I'm a certified StratOps strategic planner, and I owned an MSP for about 16 years before selling at the end of last year. I'm joined today by my friend Zach. Zach's over with Hook Security. He's the CEO and one of the founders of that organization. Zach, how you doing, man?
I'm doing really well. How are you doing, Ian?
I am awesome. I love Thursdays. I super appreciate you taking some time to come on and share some knowledge with the audience today.
Yeah,
So,
absolutely. It's great to be here.
oh, our privilege to have you. What are we talking about today? We're talking about money and specifically raising outside capital. So, Zach, you're with a software company, but the concepts of outside capital apply no matter what. If you're raising capital for your software company, you're raising capital for your managed service provider, you're raising capital for, I don't know, an ice cream store. You still got to follow a process. And so there's some specific challenges that you and the team at Hook Security identified that said, hey, raising capital is the right method for us. You said,
Yeah.
hey, like software company, you want to acquire customers fast. Talk us through this. Talk about the challenges that went on with you and your team, and what made you want to go after outside funding instead of funding it through your pockets or some other methodology.
That's right. Yeah. So when getting started with any startup, the point of the startup is to build something that's profitable, right? Most people want to bring in some sort of income, upside return, or else there wouldn't be the impetus to start. And that might be academic, but uh, I myself am a serial entrepreneur. This is not my first rodeo. I have bootstrapped companies before. We have built companies based on debt out of the gate. We've built companies on equity raising. And it's important to know inside and out what your business model is, how you believe you will generate income, what that income minus expense, what your profits will be, when those profits will be realized, and even the unit economics as you break it down to selling one widget or one subscription to one person, and being able to understand all of that before you go raise money, before you even decide which game you're going to play. It you will never, or I'll put it this way, investors of all types will never have any more clarity or insights into your business than you bring them. And so you have to be certain that this type of fundraising is what's appropriate for your business model and for your company. And so when it comes to SaaS companies, software as a service, The way that the game is played in 2022 is the question is not whether or not you have a really cool idea, a really cool piece of tech, a really ingenious new solution to a problem that exists. Unfortunately, everybody does. The question is whether or not you can commercialize that and acquire customers at a rate that makes sense for you to dominate and hold a market. So in 2022, SaaS companies defer all profits to the future. That's all we do. It does, even the publicly traded ones. You'll notice that the larger the company, the more likely they are to push their profits to the future and reinvest that in R&D and uh, customer acquisition. And so
Mhm.
that reality was something we considered when going into Hook Security. Said, oh, we could probably bootstrap this, figure this out, find a couple profitable accounts, build this up one at a time. But we were already going to be at a strategic disadvantage in the marketplace if we did that. So we said, all right, we have to do that thing where we burn cash. So we spend more money than we bring in every month, and we have since we incorporated. And we have to go out and raise outside capital to cover that delta. And
Yeah.
that's what's the truth of our. That was the early process, and we said, okay, well, we will always be fundraising at Hook Security. That'll be
Yeah.
part of it.
That's a key part of that strategy is that even though you're getting funding, you're still raising more funds because you know that we're not going to make profit immediately, and we value the ability to fund growth through talent, customer acquisition, development, research, product enhancements, what have you. You value all of that infrastructure needs to support that rapid trajectory on growth more than having sole control. It's okay to have those other binds in the room and have those other shareholders in the company.
Yeah, that's right.
So,
Yeah, that is a trade-off. Yeah, you bring more cooks into the kitchen
mhm.
when you do it this way. Absolutely.
Yeah, you're not the final say so. There's boards or shareholders and investors that you have to kind of say, hey, here's the decisions. And it adds in almost a little bit of accountability, which isn't
Hmm.
necessarily a bad thing.
Yeah,
So
that's right.
you guys made some key decisions. And there was a couple of really, really big decisions, which one of the things you said, like, we're going to be transparent with our team. We're always fundraising at Hook Security. So everyone who joins Hook Security knows that that's the strategy. Hey, we're soliciting investors, right?
That's right.
I, I think you had made a joke that when you're walking around, you've said it so many times that people say, Zach, I know we're fundraising. You don't have to tell me anymore.
That's right. Yeah, when I keep showing up to our all team huddles and I say, "Oh, today I'm talking to a potential investor," that's white noise at this point because that's
Mm,
exactly right. And we might be a little more transparent than most. We Our team knows when it's called end of cash date. So if you
mhm.
continue your burn and you don't bring in new revenues, like when do you run out of cash as a company? And we actually tell our employees that. And that has pros and cons to it. Don't get me wrong. You're telling them a number that they can't control,
Mhm.
but uh, at the same amount of you build in trust when you're able to continue, like we have, continue to successfully fundraise, and they see the value of the company grow, and they say, okay, that's just built into who we are. I can't control the fact that we burn more cash than we bring in, and the employees actually lean in, and so we have a great team that leans in more when things get challenging and say, all right, let's figure this out.
Yeah.
And it's become a great point of, and it was unexpected that our culture would embrace it and enjoy the ambiguity as a rally point as a team. Say, all right, we can't control the future. We don't know when the next check's coming in from outside funding. So let's go do the revenues thing. Let's control expenses on our own. Let's do all these other things. And it's not controlled by me, right? I'm not the one. This is just unexpected. We didn't talk about this, Ian, but uh, culturally, internally, when the team knows the end of cash date's coming up and we still need to raise outside funding, they on their own will cut expenses. So I
Well,
don't have to be top down with them. It's a pretty remarkable thing.
Well, and that sort of alignment, though, makes it easier for you to focus on raising funds. If you're not having to step in and do the day-to-day or the minutia or the operations. Hey, we got this. We're already trimming things. We're making sure things are going. We're doing our very best. We're giving 110%, which makes it an attractive, well-run company, which certainly isn't going to hurt you in that next investor pitch meeting, because they can see some business maturity operations. One thing that I wanted to talk about, which I know we'll dive into a little bit later, but this last point, we're going after 100 million revenue in target. You'd mentioned that there's different types of investors and that you want to make sure that you are pursuing investors that see your same vision, because just because you see your company as, hey, like, we think we can go here, here's our target, here's our vision, here's our path to get to our vision, someone else might not see you as a, oh, well, we're going to give you 1 million or 10 million and you're going to turn that into 10 or 100 or whatever, $1 billion. They might view you as more of an ATM machine, as a cash generator for other funds or for other companies, right?
That's right. Yeah. Investors are human too. And so they can only act out of a set of experiences they have. Right. So if they come to the table and they've made their money, their resources came from real estate or consumer goods or retail or something like that, and then they approach you and you're outside of their space, maybe even a managed service provider, you're like, hey, we're raising capital because we're going to do a roll up or take our services and expand them into strategic areas. If they don't have an experience with that kind of service level billing, or in our case, the SaaS subscription model, and what does it mean to acquire a customer, they might start making requests or analyzing your deal and your opportunity differently, and they might just discount it pretty dramatically. And so we've had experiences. I think you and I, we talked about, and this gets into some of the terms that might come up when fundraising. We talked a lot about the idea that private equity and VC are not the same thing. And private equity, even though they're in the same category, they are very interested in, what are their cash on cash returns going to be? This is not venture hoping to do equity one day you IPO or have a major acquisition and hit a home run. Most VCs are trying to figure out how many home runs they get. Private equity is worried about base hits. And so when they're worried about the base hit rules, you have to make sure you're aligned with that vision. And we've had, folks come to us and say, hey, we want to make you an offer. We want to invest in Hook. We love your idea. We love all the stuff you're doing. Oh, by the way, you guys have this dream to be a platform and change the way online manipulation looks in the picture. Love it. Sounds great. Actually, but if you get a chance to be bought out at a much smaller valuation, you think you should take it. And you say, okay. And they'll tell you, like, oh, based on our previous experience, this is the return you should expect. And so if they haven't done the IPO route, or if they haven't done a large home run or major acquisition before, they're going to advise you differently, and they're going to discount your business plan and your vision to the level that they are.
Yeah, they're going to, and that misalignment, it's okay, but you have to determine is that in alignment with what we want for the company. And so there's a couple of key pieces, and I want to spend a little bit of time on each bullet and let you expand on it. But these are things that you have to be able to build before, during, and utilize after funding series or going after funding rounds. So talk to us about data and metrics for analysis, because that's above all else, that data and the metrics and your acumen around them has to be king, right?
Yeah. And let me step back and say, when you're pulling all of your data and your metrics together, only you as the founder, as the owner, can have the narrative, right? And if you present data to people without a narrative, without a context, they'll come up with their own narrative. They'll come up with their own context on what your numbers are. And as much as investors might say, just send me the financials, I make my determination there. Well, you're not really messing with an investor as much as you are, especially a venture capitalist, as much as you are just a bank underwriter, just trying to determine by facts and figures what the risk
Mm-hmm.
is on this deal. So you have to be very careful about what data you give to people because numbers don't interpret themselves.
Mm-hmm.
So we say all the time, when you present a piece of data about your company, you also have to tell people how they should feel about it. And
Mm-hmm.
you can tell people how they feel about it by telling folks how you feel about it. And that gives the insight to the potential investor on what to do. So in our space, we're measuring things like top line revenues, right? Subscription, we call it run rate. So you take your monthly billing and multiply it times 12. That's always ARR versus your
Mm-hmm.
MRR, your monthly recurring revenues. We're always looking at that. We're looking at churn, what folks are not renewing their subscriptions with us and what impact that has over time. And then we're talking about customer acquisition cost. What is it to acquire a new customer versus the lifetime value of that same customer? So what do we
Mm-hmm.
expect based on our churn rate, the overall lifetime value to be of that subscription? And as we continue to we monitor those things, there's a number of other things that you can get into in the SaaS space. If anything, SaaS is a metric driven industry.
Mm-hmm.
So we can talk about other potential things that fit your narrative, but it's important. I got in a conversation recently with somebody trying to raise money, and they had said, "Hey, I'm just going to present these pro formas. I'm just going to show a couple slides, and I'm just going to be very factual." And I said, "No, that's great, but you are selling equity.
Yep.
You are out there presenting a story, and these investors have an infinite number of places they can put resources, and they're
Mm-hmm.
interested in this high risk, high return segment of startup investing in our case. So you
Mm-hmm.
have to give them a story that they can go tell their friends. And then once they have that story, then you back it up with the numbers. So people will make their decision emotionally and justify it rationally. And you have to go in that order, even with your decks, with all of your offer, anything when you're going out to raise capital.
Yeah, that data without being paired with analysis or that story becomes noise, really. And without that, someone can look at it and it's that old is the glass half full or half empty, or should we be talking about the value of ice? It's the same glass, same amount of water, but there's three different interpretations there.
Oh yeah, yeah, that's absolutely right. And I see it all the time where before an investor will say, "Hey, can you just tell me what your projected revenues are in the next 3 years?" Right? And founders like myself will just say, "Okay, yeah, here's the number." Right?
Yep.
But that's not helpful to the investor. The investor
Mm-hmm.
needs to say, like, you got to say, like, listen, given the context of our industry, we think we'll be the fastest growing in our industry, right? So you're giving them like a comparative analysis jumping off point. This is
Mm-hmm.
not a stretch number. We feel strong about it because we have the teams and the leads in the funnel to make that happen. So you're giving them other context. And out of that, we expect to, and then you got to give them rates of return and because they don't know what to do with you tell them next year we're going to do 2 million. But if you say next year we're going to get 3x our growth at 300%, and the following 2 years we're going to do 200%, they start going, oh, I don't, I didn't have an idea in my head what the
Mm-hmm.
line was to cross, right? I didn't have a measurement or a standard say, if they say 1.8, I'm out. But if they say 2 million, I'm in. They don't
No.
have that as investors. You have to tell them how to feel about it as you give them the number. And
Yeah,
then, or you can ask them point blank, like, well, is there a number that would excite you guys? Right?
yep. Here's
Ask them.
here's the path that could go over to that, and even describing market channels. Like here's just natural growth, and here's by market share capture, which is where you kind of come in. Your funds enable us to do more of this market share capture thing. Here's the addressable market and how we can go after it. So talk about the pitch deck. We spent quite a bit of time before we dropped onto this webinar, and so if you're in the process, if you slide down to the process around step 4, this is really where we're kind of diving into some of those meat and potatoes on step 4 of the actual process. But talk to us about the pitch deck and what goes into that infrastructure. You have like the that investors care that you're taking their $1 million and giving them, go out and make $100 million and then coming back to them to sort them out. Talk to us about what's a pitch deck, what's got to go into it, what maybe you need to keep into an appendix or a bonus deck. Walk us through that.
Yeah, so in our short tenure at Hook, going on 4 years, I've written well over a dozen from scratch pitch decks, right?
Mm-hmm.
And because there are a number of opinions and points of views on what should be included and not. So rather than tell you these are the 12 slides I recommend, and here's the 12 bonus slides, I'll say it this way. You need to be absolutely clear the problems you solve.
Mm-hmm.
And that problem statement, so at Hook Security, we say, like, we solve training the non-technical user to recognize online manipulation. Okay, great. That's cool. What's that mean? And so we solve it in different ways. And then we're very clear that we also solve a market access problem. We solve a delivery problem. We frame everything that we do in the terms of the problems we solve, because as an investor who doesn't know your space or your niche or anything about your new tech, they can, in a concrete way, capture, okay, even if I don't invest, I know that this company solves this problem over here. And that's helpful for them to carry it on and pollinate it to their other investor friends. And so I make it a point that needs to be crystal clear in your deck. And you can do things like, I've seen some decks that are pretty powerful where they'll say, here's this problem, therefore this problem, therefore this problem.
Mm-hmm.
And then your solution is, so we solve this problem, therefore we solve it in this way, therefore we solve this thing, right? You can create those narrative structures, and I think those are important to be very succinct. And depending on your stage, if you're first starting out, pre-revenue, early revenue, don't have a lot of traction in the market, it's more idea and team based, then your deck should build confidence towards that idea and the team. If you're maturing and you're raising capital and you have metrics to back it up and you start having historical data, even at the Series A, it might not be statistically significant enough to actually create true historicals, but it gives you direct direction. And so it can be directionally right to begin and build that into your deck. So depending on where you are, I think it's very important to understand what audience is looking and needs from you to make a yes. And that's how you should approach building your deck.
I love that. So one thing that goes without saying, but it's important to say, is you need to have solid financial models. You need to be able to show a path to when you shift into profitability, and you can't BS the numbers, right? Like every entrepreneur knows that sometimes when presented with a situation and presented with data, you got to kind of spin it. You got to kind of spin the room. You got to spin the result. You got to spin what happened you have to create that company line. And while you are creating that company line through a narrative and, hey, here's how to interpret things, you do have to have a model that if someone is a mathematician says, like, yes, the math is sound. You can't use fuzzy Washington math.
That's right. So every investment that any, especially in venture capital, has ever made, they have dissenting opinions even within their organization. And so you have to embrace the fact that an analyst not in the room with you is going to read your numbers and come to conclusions. There is going to be some sort of due diligence underwriting where you can't be in front of that person. So what has to happen is your numbers have to match the story you gave your champion in the organization. And so any, incongruent, you can only claim admin error or typo a couple of times. You really can't be stretching. It needs to be aligned and buttoned up tight. You have to make it easy on the investor to invest. And you make it easy by keeping the same story throughout all documents, throughout all, even your pro formas, your financial modeling, etc. And I'll add it this way. I did have an investor tell me once, he goes, listen, as a founder, like, you guys have the magic. You guys are the experts. He's like, he's at a point in his career. He's like, I don't know how to make straw into gold anymore. You guys
Mm-hmm.
do. You guys go 0 to 1. You take straw, you make it into gold. That's awesome. Um, and so, um, where was I going with that? Oh, so when we show up, we have to be experts on how we take his money and then give him a bigger check back, or how we take her investment, her time, and give her more back. So
Yeah.
we do have to know our numbers cold. These are the things that matter to them, because this at the end of the day will show the results. We need to understand so deeply and intimately. We cannot yada yada pass the, yeah, we'll take yours, we'll go market and sell stuff, and then we'll come back to you with higher revenues and we'll all be good. Everybody high five. That's not going to fly. They want to know that no matter what they poke at or what rock they kick over with your company,
Mm-hmm.
you have embraced the challenge and you know how to approach that.
Yeah. And that you have that I really want to circle around and re-emphasize that you have to be the expert on your own numbers. They can't be a surprise. You have to be expect curiosity and expect skepticism, because of course, if you're asking, hey, I'm not asking you for like, hey, could I have a peanut butter sandwich, Zach? Like that would really help me go do some things. You're going, yeah, here you go. Here's a peanut butter sandwich. Like you make me a peanut butter sandwich sometime later and we'll call it square. That's not really what we're talking about here. You're asking for someone to give you hard earned cash. There is real money in this that is going from them to you that they're now not going to be able to use until they are able to liquidate that equity in your company.
Mm-hmm.
And so you have to be able to present that to them.
That's right.
And then you talked about building a prospect list, building kind of this concept around, hey, you need to have a list of people who you could go with to start the conversation when you're actually going and seeking funds. Talk to us about building that list and what goes into that, and yeah, talk to us about the prospect list.
Yeah. So on one hand, there's a number of online resources and database where everybody who invests or is potential investors has put their name, and they usually have ways to sort and filter those out. So I'm happy to share any resources with you, Ian, as well. But you can go on something as simple as like AngelList.co, and you can start by saying, all right, what's appropriate to my level in my company and my, pre-seed. Is it just an idea? Is it seed? I'm trying to build out the idea and start revenues. Is it there's a couple of bridge rounds that are starting to become popular in between, but the next one be Series A. Your A round is the moniker, or A represents your large funding. Like this is when we're standing up and beginning to scale. That's in the SaaS world and a few other um, industries. That's a pretty typical. So you filter out and figure out who writes checks of your
Mm-hmm.
size for your type of company, for your industry, and you start there. Now, there are a couple of resources online that now rank the reputation of VCs from current founders who've taken money from them. So there's starting to be a little bit of equanimity in the relationship. So you're not just, all money's not equal, and you can start figuring out which investors have the right type of values and ethics as well as vision as you, and you can start interviewing and bringing that down. But um, when it comes to early prospecting, it's just like building a funnel with sales. You're I saw a report recently on a VC release. They said, "Hey, we've led these last 5 investments with these 5 companies, and between all 5 of them, on average, they reached out to 68 firms. They got, I think, 18 meetings booked, and there's first, second, third meetings. And on average, between 5 companies, they started with identifying 68 prospects,
Mm-hmm.
and they got 3 term sheets and made took on one investment, which happened to be the VC that's promoting them online. And so I think that's fair, and that's what you're getting is
Mm-hmm.
you're when working with investors, you're up against the sum total of everywhere else they can put their capital. And if
Yep.
you're raising early, like you mentioned, you're locking their capital in for 5, 7, 10 years, and that's if you do it. Uh, you know, you might end up having to burn the company to the ground and throw away the key, and then they get zero return.
Yep. So you gotta be able to take that in and see it from their side. So let's talk about some early missteps. Some, one of the common ways that folks learn, especially myself, is I absolutely learn through mistake and then self reflection. So, what are some of the things not to do when you're trying to go out and raise funds?
Um, so fundraising, again, like sales, is not so much about task management and lead management as it is about time management.
Mm-hmm.
Task and lead management come out of time management structures. And the the issue that you'll face early on when fundraising is there's a when people approach you because they hear you're raising funds, typically, um, in my experience, they have not been good fits, right? Because if
Mm-hmm.
they have enough time to casually talk to you about your deal at your convenience and your way, you're filling their pipeline, you're filling their time. And um, in my case, when with as early as we are as a company, now later on, uh, I fully intend to use these groups, but wealth management individuals and investment banker groups are very difficult because they're not managing their own money. They're just trying to
Mm-hmm.
bring deals to other people who have capital. And most of the time, if you don't have a runway right now, especially in 2022 with the capital markets being on their heads, turned upside down, your the likelihood of you getting any capital from an investment banker relationship as you're starting off is virtually zero. And that's going to
Mm-hmm.
just eat your time. And so you have to pay attention. Now, I have used investment bankers, wealth managers, other growth fund, large private equity to perfect my pitch. I've gotten on and pitched and
Mm-hmm.
got their feedback on if they pass, why they would pass. And most of the time they write checks too big. Like, it doesn't make sense to underwrite your deal. But I would pay very close attention to make sure you're controlling your time when it comes to talking to potential investors. Absolutely.
I love that. Making sure that the management of the time, which an easy metaphor to equate there is how, like, what is the cost of going after a non-ideal fit? It takes just as much sales resources to go and make a proposal for a 10 user site as it does for a 50 user site. And if you specialize in 50s, you're wasting your time with the 10, and if you specialize in 10s, you're wasting the time with the 50s or the 500s, and you can't buy more time.
That's right. That's right. Yeah, Jeff Bezos had just as much time as we've had, and so
Yep.
we didn't get a different set of time. I will say that um, it you have to pay very close attention to um, how investors view their relationship with you, and you're taking signals in a lot of different ways.
Mm-hmm.
My favorite investors at this point have been brutally honest uh, about either our state of our company, what their concerns are, or their own investment track record and the like. So I am not afraid to ask when getting on a call first thing, do you have a thesis and conviction in our space?
Mm-hmm.
Right now, could you demonstrate and tell me who the competitors are that we face without us at like, and if you do, let's rock and roll. Let's expedite this conversation. If you don't, it that's a signal I'm going to have to manage the relationship in time because I'm going to have to bring up somebody who has little to no exposure, and ultimately they're just going to bet on me, maybe the idea, maybe some IP, but largely they're just going to bet on me to
Yeah.
be the expert, which is fine, but that takes more time. That's
Mm-hmm.
what eats up your time. If you have to help somebody develop a conviction about your particular industry or niche.
Then, and if you're having to spend that time educating them, that's time that you can't spend getting in front of more qualified investors, closing the deal, and running the company and growing the company.
Yeah, there is far more capital out there than anybody can get their head around.
Mm-hmm.
And so it's out there, it's ready to go, it's ready to be deployed. And so getting a no is perfectly fine. You should be very comfortable getting no's if you're going to go fundraise. Well, I guess you're running a company, you're a managed service provider, or the like. You're used to getting no's. You're going to get a lot more of them in fundraising.
Well, it's the second best answer you can get in sales there. So, looking at our process, we've got to develop the offer and pitch, and we've got to figure out what our desired funding amount, terms, rates are, etc. So, one of the key things here that you mentioned is that there's investors and there's advisors. Talk to us about investors versus advisors and why you need both when it comes to fundraising.
Yeah, so one of the things I think is pretty important when it comes to fundraising and fundraising advisors is the idea that your advisors, especially the ones that have been there in your shoes before, are gold. I got off the call yesterday with an advisor who led our bridge round back in June, and I was just telling him, just dumping all my issues from September onto him. Here are our challenges. Here's what's going on. Am I thinking about this right? How do I reposition my head around this? These things that we faced in September. And as an advisor, he knew exactly. He's like, I get it. You're pissed. You're also disappointed. You feel isolated. Great, cool. Now let's talk about what that means in your own mental health, in your own head space, so you can go out and continue to invest, right? So they are my boosters, right? If this is a sports metaphor, college football, what have you, like they're my boosters. If I'm the head coach, now I get to go back out and play the game again.
Yep.
And your investors, right? They, most investors, even if they're active, are going to have a number of other priorities in their lives. That most of them invest relatively or passively, even if they're like, yeah, I'll be on your board, I'll help you read this document, I'll introduce you to people. All that's perfectly fine, and it's simply just gravy to their investment. So I think one of the things that helps early on when trying to raise money and people don't know you from Adam, you show up to an investor, you show up in VC, is being able to bring that social capital is helpful. It's not going to close the deal. It's not going. You're not going to say, look at my advisors. I have, Bezos and Elon Musk personal cell phone, and I call them all the time. The investor is going to say, okay, cool. You know how to build a network of support. Great. But let's talk about the merits of your deal in your company.
Yep.
So advisors are never going to close the deal for you. But at the same time, they can get you the meetings. They can help with that booster spirit, and they can help encourage you along the way. And investors are a different group of people. And I will say it's possible for investors to be key advisors, and mine are. The guy I called is an investor and an advisor. But the vast majority of investors today, there's 18 folks, institutions, and individuals on Hook Securities cap table, and 3 of them come to mind as somebody I actively engage with.
So the majority of the time, the investors will be a little bit more passive.
Yeah, call me when you need me.
Yep.
Have a great. Good luck.
Let me know when we're doing another funding round, and we'll see if we want to do more. That type of stuff.
That tends to be it. Tends to be the MO.
So creating a checklist before you go to your advisors of what you're looking for so that you can follow a process, kind of scoping out, here's the agenda of what my pitch meeting is going to be. Here's my process for managing follow-ups is always good. We talked at length about that pitch deck, making sure that you've got that pitch deck ready to go and creating that prospect list. And then if we're going to step 6 in the process, you're going to be going after those initial investors, those initial targets. And one of the things that you said, which was a great metaphor, and I'd like to dive into, is you want to create a pool party. Talk to us about the pool party when it comes to leading the funding round. Talk to us about how you're approaching those initial prospects and how to turn a no into something valuable.
Yeah. So the metaphor, I like to use is the pool party, and it's simply the idea that you're trying to get a group of people interested in you all at once. You're not. Investors don't like to feel like they're alone and that they're the only one out there as a group. And there's reasons for that, especially in venture capital, right? Because one investor might make an investment early on here, but approach another firm later on and say, "Hey, they're raising another round. Would you like to participate?" So everybody is talking with each other. It's a small world when it comes to venture capital at the aggregated level, and so you're trying to create a pool party where everybody's interested at once, and you're trying to get them. And then what happens is you create this, to switch a metaphor, a horse race, and you get them all grouped together. Now you need to figure out who's going to set the pace, right? And you'll get people that say, "Listen, we only do follow on, so somebody else does the due diligence, somebody else, and they set the terms. We like your company. We'll participate when a lead investor sets the terms around." And we're actually negotiating that now. We have follow-on investment commitments from our current investors that equal about a third of the round raise. So we're trying to raise a $6 million round right now. And so what that practically means is, we've gotten, 2 million circled up. They're sitting at the pool party, but no one's jumped in the pool yet. And now we're negotiating with a number of other firms who would take a lead position, price the equity, figure out the valuation, all the preferred preferences built into the preferred shares. We didn't make this a technical talk, but we can talk about what preferred and common shares are, what all those preferences are, set the board, set everything up so it's a formal company, because this would be our A round. And they typically, a lead will take, there's about 50% of the round is pretty normal. And so they do the due diligence. They come in and say, "All right, we've got your 3, we got your 2 already here. Let's go find the last million or more. Maybe we oversubscribe the round. Let's declare victory and go." And so that lead is very important. And not everybody is a lead, so you have to ask them in the process, "Do you guys lead?
Yep.
Do you typically follow on? What do you like to do? Do you like to take the whole round? Do you have percentage ownership targets?" When at the end of post money, if you own less than 10% of the company, are you going to be excited? No? Okay, well, we got to make adjustments there. So you learn how to negotiate all that. And I would say the lead, it's pretty typical that if they lead around, especially early on in your Series A or what have you, expect that person, that personality, that institution to be with you for the lifetime of your company. They're gonna see you through.
Yeah,
for better, for worse.
They're going for the long haul. Yeah. So you got to make sure that you're willing to essentially be a partner. You got to, like, I'm okay with going to the rodeo with this person for the next 7 to 10 years. Like I want them in my room.
Yeah, these are the people jumping into your pool, getting everybody else to jump in. Pool party started. And now we're going. Yeah.
So, talk to us about messaging, because one of the key things that I thought was really, really interesting was getting funding is the same as any other sort of sales job. And being someone who's been in sales for 20 years, you never lie. Lying never works. You never want to lie about something. You want to set good expectations. You want to represent something fairly, but you do have to have the art of the sell. You got to be able to stitch together. You got to be able to paint the picture. So talk to us about creativity and how that needs to have a space in your approach to investors.
Yeah. So part of my issue coming from a sales background myself is I tend to say things that are only concretely true, right?
Mhm.
Like I won't mention somebody we're also talking to or a feature that will be dropped next week that will solve this prospect's problems and what have you. Um, and which is perfectly fine and fair then in the sales world. I what I tried to sort out is it's this learning into the investor world, excuse me, because they're also living in the future with you.
Mhm.
They want to know what seeds are being planted right now that could be something. And they're
Mhm.
trying to find what reasons to say yes or no. And if they're leaning in and they're building a conviction, they want to say yes, being able to tell them, listen, I'm going to be on a phone call and drop this name, or I'm going to be at a meeting and drop this name. It gives you further social proof. Or you say, listen, we're in the final stages right now of an RFP that will really do this for us. And our likelihood is greater than 50% on that. And like being able to bring that information in, which I would never bring in on a sales level,
Mhm.
uh, that's just part of the lines I draw. Uh, that's actually what the investors need to hear. So you need to stretch it in there, and you need to find creative ways to mention, to bring in um, what what validates the narrative you've already told them, and gets them even more excited.
Yeah.
And give them that emotional coverage that they need to be able to work through your financials because no startup's financials are perfect. So
Oh
you got
yeah.
to give them that edge, and I think that's a distinction that I'm still trying to play out, and I rehearse myself with investors to make sure they get the full picture, all the things, the really cool stuff that we got going on, that's in the lab, it's baking right now, things, conversations happening. I got to let you know about it. Doesn't mean it's in the bank. Doesn't mean it's
Yep.
closed. Doesn't mean the contract signed. But I need to let you know about it.
Yeah. You gotta keep people excited. Management in this looks like a typical, like a fairly typical sales funnel, right? You've got your investor prospects, and then those lead to a prospect leads to a pitch meeting, and then that pitch meeting might become a letter of interest or a like a hey, like let's have a further discussion all the way down to a close. But you essentially management to keep us on time. You're looking at that, you're managing your funnel, and you're setting gates and percentages. And if your percentages start to go off, you pivot, you look at testing, you do A/Bs. Correct?
That's absolutely right. Yeah, and in the VC world versus private equity and others, uh, part of the uh, challenge is making sure. Um,
Mm-hmm.
uh, sorry, uh,
Yeah.
part of the challenge is uh, making sure that you're optimizing, especially at the beginning, because how you discover and get into a VC relationship will see it through, right? That's one of the A/B testing things we discovered. And there's already a pretty set pattern, which is you send out your deck, you make it easy, you're in the intro, you get a first meeting, usually with a junior or an analyst, you get a second meeting where they pull in other people. Third meeting, you're hoping to meet with a general partner or managing partner. After the third meeting, it used to be that it was pretty typical that if they were going to lean in, they would submit some sort of LOI or term sheet. That's not really the case anymore. Beginning last quarter, they're starting to go into due diligence, get you to what's called an investor committee meeting. At the investor committee meeting, that's where the whole firm or whoever is
Mm-hmm.
part of that decision gets together. They have their process to decide term sheets or terms are discussed, due diligence, and then term sheet signed. Usually, term sheets anymore still have exclusivity periods, so they lock out anybody else you can talk to during that point, and then they go to close.
Okay.
And so it's also drawn out. Uh, in 2021, when money was just flowing freely, um, there would be people who could close on money in a month. I'm being told by my colleagues and what we're experiencing ourselves that that's now about 3 months from that first pitch meeting all the way through to close.
so that the tightening of capital is flowing through. So we just spent quite a bit of time, and there is some questions coming in. For those of you who have questions, go ahead and send them out. I'm going to collect them up, and I will be feeding them over to Zach. But Zach, really quickly, talk to us about Hook Security. What are you guys doing? What can you do for the managed service community out there that can help them stand out and potentially help them be able to create a narrative where maybe they might be able to pursue their own funding? So
Yeah, so I think MSPs have a unique opportunity to. Uh, so previously, MSPs, as far as I understand, right, had advantages that were based on experience, tech stack, geography,
mm-hmm.
and or market category. Like they were really good at hotels or dental offices or what, right?
Mm-hmm.
Um, I think there's an emerging opportunity for MSPs that uh, this is still early on, but creating user experiences, reaching past the buyer at a small business, at a law firm or accounting, and creating technology experiences. That's a big category. I'll tell you what I mean by that. But creating those things that users like. So, take for example how much the earth moved with Adobe buying Figma here recently. Why did Adobe buy Figma? Right, $20
Mm-hmm.
billion acquisition. Um, Crazy. Uh, Adobe built a tool and a solution over the years for the buyer, largely at an enterprise. So they bought it for the marketing or the creative buyer at a large company and said, here's your tool set, here's everything you need, all that. It's easy for you to manage. The users, especially as interns and other people came in the company, would go out and use Figma because it
Mm-hmm.
was much easier, much more user friendly than Adobe. And eventually, there was this push where Adobe is losing market share because users are coming up with a tool that makes sense for them. Who cares what makes sense for my boss?
Yep.
As a tool set. And when we think about how the users, the employees at the clients we serve are experiencing our technology, it's no longer just what makes the client buyer happy. The the competitive advantages lie in making that user employee experience better so
Mm-hmm.
that they interact with your brand and your company in a way that makes their lives better and easier, and it drives demand up to the management. So I think taking a cue out of Figma's book, uh, there is a tremendous amount of opportunity for MSPs who move in that mindset and say, what technology stacks, what expertise can I develop, what kind of marketing and messaging can I bring to the table that does just that.
And so Hook Security can help out with that. The website's right here. I'm going to point out that it's .co. There isn't a dot. There isn't an M there, so make sure you use .co. I didn't misspell it here. I'm gonna put that out there right now. And as
Thank you for
someone who
that.
also has a fun, goofy domain name extension, we're a Doc Consulting here. The amount of times people are like, so docconsulting.com? No, Doc Consulting. I didn't misspeak.
Right.
And so, a reminder to everyone that there is that handout over there. Go ahead and download that. That's yours to take. And so, Zach, we've got a couple of different questions here, and they're along a theme. So I'm going to stitch together the theme for you. A lot of people are interested in the capital structure when it comes to investment. Percentage is a common theme amongst the questions. Hey, how much percentage should you expect to give up in an early round? But a couple other things is, do people get diluted as time goes on? So does a Series A get more equity than a Series B, than a Series C? Also, how do you know when you should be exploring giving up equity? And how can you maintain control through the various rounds of fundraising? So I'm going to let you kind of do that, and that's probably will take us through to close. So go ahead and do it, and then I'll let you know when we're getting to that 60-second mark.
Yeah, these are some great. That's a great set of questions. Um, so one, I will encourage a framing that you can control a company while losing equity percentage. Right, those two things can be separated out. most of the time they're put together because they're, for most businesses, especially small businesses, 51% is the magic mark to make sure that you're not getting diluted and pushed out. And that's what
Mm-hmm.
he owns the most shares, controls the company. When it comes to this type of fundraising, you can actually sort those out where you can have permanent board seats, you can have permanent controls, fixed shares, super majority shares. You can do creative things with right type of attorney if you would like to manage control throughout. Um, Up until 2022, it was still pretty true that every round you could expect to give up between 10 and 20%. So every time you go to the well, you're giving up 10 to 20%. I mean, Bill Gates owns like something like 5% of Microsoft today. I mean, that's what
Mm-hmm.
dilution does, right? As the pie gets bigger, your share of it gets smaller. So it is
Mm-hmm.
one of those, ideas like, do I want to own 100% of this set pie, or do I want to try to grow a pie and own a smaller percentage? That's the math, the trade-off you have to do in your head. So in 2022, we're seeing that the early rounds are still right there at the Series A. You should expect 10 to 20% dilution, depending on what you did early on. But the later rounds are looking like they're getting a little bit bigger. Valuations are depressed. Some people are being caught holding the bag at that CDE if you're headed towards an IPO. I don't know if that answered the questions succinctly. Did I capture everything there?
Yep. And so, Zach, I think my internet might have cut out a little bit there. So
Okay.
we're kind of pretty close to the end of the webinar. If I'm still broadcasting, if you can still hear me, you can visit Zach over at hooksecurity.co. You can visit us at arendar.consulting. There you can view other on-demand live casts, previously recorded webinars, look at our podcasts, grab white papers, blogs, etc. Zach, I really want to thank you again. If I'm making it through on the poor internet, for joining us and taking some time today. Really appreciate you taking the time out of your day to come in and share your knowledge. And I'll let you close it out if you can hear me. Go ahead and
Yeah.
take us away. We got 40 seconds left.
Yeah. So anything that I can do, I have a passion on helping other startups, entrepreneurs, folks that are out there raising capital, trying to get something from 0 to 1. I even built 2 high schools and a middle school to do just that with young people. So tag me. You can find me on LinkedIn. I'm the only Zach Eichenberry that's ever existed, according to Google. I have a made up last name. So feel free, find me on LinkedIn, send me a note, go to the website, hunt me down. I can send a booking link to Ian if that's helpful, and would love to talk with you if your journey includes getting something from 0 to 1.